Woo! Episode 38, True North. We are back. And in the spirit of decentralization, we successfully repelled a DDoS vacation attack. Jeff tried to get us to take some PTO, but then he doesn't pay us. So that really didn't make any sense. So Dan was ripping the research and couldn't help himself. So we are running the episode tonight. And just to give a little background, if anybody's tuning in for the first time, Jeff put this group together to try to filter out some of the signal in what has been described as what will be the most hated rally in finance, and we're just trying to filter out some of the noise and provide some signal. So Dan is anxious to rip the research. So what do you got for us tonight?
Yeah, I think the topics I want to cover, I think this is going to be a very abbreviated True North. So probably we're going to cap it at an hour. So we'll go 9 p.m. Eastern to 10 p.m. Eastern. We'll hit the important topics. We'll let you get on with your evening. So I think first we're going to talk a little bit about macro stuff. We'll just kind of bump ideas off each other. I'm not really a macro guy, but I think it's important to understand the entire picture. Then we'll hit on pref stocks, just the ex-dividend dates and the payout dates, specifically stretch. We'll talk about the mechanisms for which stretch is able to be stabilized. And that's kind of, coming up. We traded up to almost $97,000 today. And that's pretty important. It kind of is the future of both strategy and Bitcoin. Just generally, stretch is like a, pretty important product in the entire scheme of the Bitcoin market. If we're going to attack the bond market, stretch is the product to do it. And then finally, a little bit of the pref stock ATM. I have some kind of charts that show how the pref stock, or when the pref stocks have been issued via ATM, the volumes there. And finally, is there anything else? We'll go with that. Maybe there'll be some bonuses.
Cool.
So I'm going to share my screen. This might be a 30-minute episode. You guys get lucky. Okay. So please hop in. Just
right on.
Interject. Yeah. Is there anything you want to say before we get rolling? Anything you're thinking about in terms of price action? I watched your video today. It was great. You're just hustling shares, aren't you?
Yeah. It's business as usual, and nothing's changed about the thesis. I know people are getting bored, but it doesn't even seem like this is capitulation. It seems like they might want to put the screws to the price a little bit more, but hopefully Bitcoin rips and we rip with it.
I agree. Soleil, let me stop sharing my screen for 1 second. I put on a hat for us tonight. It says Strife. Okay.
Hell yeah.
Thank you. All right, we're looking at the manufacturing and services ISM. The manufacturing ISM is in contractionary territory. Just around 50. Anything below 50 means it's a diffusion index. So across a broad survey of different manufacturing companies, the manufacturing base and supplies and resources are contracting. I don't have a great handle on exactly what it is, but the charts look squiggly. So then the services PMI has been, pretty tightly correlated to both global liquidity and kind of Bitcoin price. You can see these two peaks during which have been kind of boom cycles for Bitcoin. And we're still in a kind of a contractionary services period of time. And I think that's quite good for Bitcoin price. Again, we're sitting along the power law trend growth. If you look back, our historic CAGR has been like 50%. We haven't had any real sort of crazy moves up. So I think, sitting here in spot, there's never been a better time to just sit in spot Bitcoin is the way I look at it right now.
Mm-hmm.
It's at FTX collapse, you'd probably want to be in some leverage if you're a Bitcoin believer. Twist your arm, you probably want to be in leverage. Here, who knows? I think right now, spot Bitcoin is like your friend, or that be MSTR spot, whatever it is. Spot holdings with very little leverage, awesome place to be, in my opinion. And if you're a covered call seller, selling upside here, the market's still kind of hot. Premiums are still kind of high relative to volatility. If you're a call seller, your mouth is watering too. I imagine yours is Soleil.
Yeah, and even if you are just in spot and you think, okay, the bull market has run its course, you're not leveraged. So yeah, you can just sit in spot and you can grit it out through the next bear market if that's what happens.
Yeah, what do? We drop to 80K from here and you're sitting in spot. Fuck them. You just lever up 30% of your port into like 3-year out call options on margin. And that's what I would do. That's why I think spot's such a good play here. But if we move up, significantly, you're not missing any of that upside. I just think it's really hard to play leverage right now. And that's something, I'm managing outside money, and I'm like trying to figure it out, trying to really figure out how to position. And so I think being conservative right now is a good way to do it. Conservative, aggressive, but more conservative. Yield curve here. Yep. Obviously, we'll see what interest rates bring over the next 6 months. I think that's really the big unknown. And I have a little bit on the Jackson Hole speech that Powell gave. Some interesting tidbits. I don't think people really know what's going on. 50 basis point rate cut. I mean, I've heard, so the market's expecting a 25 basis point rate cut in September. Mm-hmm. I've heard theories that a 50 basis point surprise rate cut would be incredibly bullish. And I've also heard it would be incredibly bearish because of, indicates a weak underlying economy. I don't know. Let's cut rates. Let's get these rates down. Let's send Strife to the moon. That's kind of what I'm thinking. And so you can look here, and we'll just benchmark the credit spread. So obviously Stretch, the shortest duration strategy pref, should be benchmarked off the, shorter T-bill risk-free rate. So they're trading at about, right now, a 500 basis point credit spread, which quite frankly is just insanity. And then you look at something like Strife, which is a longer duration instrument. It's a perpetual duration instrument. You should benchmark it off sort of the longer term rates, which are closer to 5%. And so it's trading closer to a 400 basis point credit spread. That makes a lot of sense considering it's the highest in the capital stack. Now, if you look at something like Strike, which is underappreciated right now, granted, it's lower in the capital structure. So that's the key. Why is Strife different than the other prefs? Well, they can't go out, it says in the prospectus, they can't go out and issue any equity that's senior in either liquidation preference or dividend payments. So Strife will be the top preferred equity, the highest rated preferred equity, no matter what. All the rest of the prefs, they can slot new ones in any which way. So I think that's really depressing those credit spreads, increasing the credit spreads, depressing the kind of principal appreciation for those securities. And when you look at something like Strike, if you subtract out the convertibility, let's actually go to this here. Mm-hmm. So like, see this? Let me switch the tab I'm sharing. Window. There you go.
Got it.
If you look here on the Strike, this is an update that they made to Strategy's website. It's the equity component. And this is something I think Jeff and I and Soleil and all of us kind of parsed out along the way. We were like, okay, how do you price this Strike thing? And everyone's like, oh, well, there's an embedded call option, but it's far out of the money, so you can't really price it. And, the market's discounting it. You can convert Strike now if you'd like. I forget who you call, but you call someone and you can convert your Strike into
really?
You can, yeah. But so like no one would ever do that, right? Because why would you do that and lose $50 or whatever it is, $55? Like you're a fool, or $65, $60. But the point being is you got about 35.8%. 35.8% of your Strike holding is exposure to MSTR, and that's an important part. So okay, you subtract out the 30. It's 35.8%. It's $34. Subtract out your $34. You're getting like a 13.3% cash on cash yield when you subtract out the convertible portion of Strike, which is insanity considering it's a cumulative dividend. Stride, non-cumulative dividend. So if the dividend doesn't get paid, they miss the payment. It's terrible optically, but there's no really recourse by which the shareholders have. Strike, on the other hand, if they miss that dividend, it starts compounding against them immediately, and they can't pay the Stride dividend until the Strike dividend gets paid. And then furthermore, there's a million reasons why I think Strike holders will be able to vote someone in as a board member to make sure the dividend gets paid. There's a bunch of protections around these cumulative dividends. So the fact you're getting a 13.3% cash on cash yield on Strike, I think, quite frankly, is insanity right now. Absolute insanity, considering the price at which Stride is trading at. So either Strike is cheap or Stride is expensive, or people are pricing in a drop in MSTR via Strike, which wouldn't make any sense. That would be expressed in the options market. So we got all of those things working for us.
Yeah, that's wild. That's got to be like voting machine in the short term and weighing machine in the long term. And the market's got to figure it out eventually.
Exactly. I think Strike is like insanely undervalued. I mean, so like, let's say you want to hold MSTR and cash, right? Well, you could hold MSTR and then hold cash. But instead of doing that, you buy the package that is STRK. You get 13.3% yield on the cash portion of which you're holding. you also get the MSTR exposure, plus you get the liquidation preference, the moving liquidation preference protection. So if something happens to strategy, if for some reason something happens to the common or this, that, and the next thing, you have this protection in the case of bankruptcy against your entire package of the cash and the MSTR. So I think Strike's like a relative to the common. I think it's an extremely undervalued security right now. Granted, they have this monster ATM out on it that is kind of nerve wracking, but I mean, they have now a monster ATM right back on the common. So I think Strike's a good buy, personally.
Mm-hmm. Yeah, I still haven't dipped a toe into any of the preferreds, and I don't know. I had a little bit of I don't want to say regret, but I think some of you guys that jumped on it right away rode that quick repricing. But even when I did the calculations, and I think at current rates, the theoretical ceiling was over $200 a share, and if rates come down, at that ceiling just keeps getting higher, and there's no reason it shouldn't be trading at that ceiling now, really. So still early, I think.
I completely agree. It's just weird because obviously we don't look at interest rates. Like I never really looked at interest rates. For the past few years, I was just a diehard Bitcoiner. But like looking at the bond pricing, all this stuff, when you put it in a Bitcoin framework, it's pretty interesting just to figure out what these securities could potentially do, especially now that the collateral base is continuing to be expanded via the common equity issuance. It's only going to bolster the credit worthiness of all of these securities, potentially tightening the credit spread and upping the principal over long amounts of time. So, as the liquidity develops in these products, like these products they're quite meaningful. And I think people underestimate their impact on, they're like, Bitcoin's supposed to be a peer-to-peer cash. Why is anyone talking about the prefs? These are securitized bullshit. I mean, the global bond markets are absolutely the biggest capital markets in the world. And if you want the money to turn into Bitcoin, this is the conduit by which that can happen. So, I mean, I think they're a pretty big part of the story. And I think they'll continue to be a big part of the story.
Yeah, and I kept getting surprised by the new preferreds, right? So Strike came out, it's like, okay, let's digest this, let's figure it out. And before we had even really figured it all the way out, they released another one, and then another one, and then another one. And now I'm just kind of like, I'm kind of anxious. I'm like, where's the next flavor? I kind of want to see what they come out with next.
Yeah,
and
don't they have an addressable range? They mentioned it briefly on the latest earnings report. I think it was mid-duration kind of fixed securities.
Yeah, and there was that big, black space in between.
Yep.
I think it was somewhere between like 4 and 10-ish years on the duration.
Right.
So, I mean, I was kind of thinking, because you mentioned rates and maybe the rates will come down. And kind of a side note on that, it's like, yeah, if they lower rates, then that signals weakness, and the market could tank maybe temporarily. But I think that would kind of just be a repricing event. But if they don't lower, and the market is expecting it, the market might have like a taper tantrum and crash anyway, kind of like demanding that the Fed lower the rates. So the market's going to get what it wants to get. But you mentioned the Fed, and it kind of made me think about the next product that might come out. Maybe it'll be a variable interest rate like STRC, but instead of them controlling the rate, it'll just be tied to like the Fed rate or something, like maybe Fed rate +5 or, whatever.
Yeah, I think you're totally spot on. And that's a pretty standard kind of product that exists in the market. So I think that's something I need to do a little more research on. Maybe we come up with an outline for what it could be, and hopefully we get it right.
Yeah, maybe we'll have a competition so you can guess the next pref.
Yeah, exactly. That'd just be pretty cool. Labor statistics. Jobs came in below expectations for July. Okay, nothing really new to see here. And, job growth has been slow over the past few months, like this slight weakening. This is non-farm payrolls. Non-farm payrolls. No, I don't have that here. Sorry. Unemployment trends, unemployment rate here starting to tick up, slight weakness in the economy. That coupled with the Jackson Hole speech, we'll see that I think they're kind of laying the groundwork for justifying rate cuts as Powell's on his way out, especially this kind of weakness in the labor market. And now that inflation isn't a fixed target, it's just to stabilize prices. We'll see how that kind of provides the framework for for future rate cuts. Fed funds over time. This is a pretty interesting chart, and I think everyone in their head, I mean, most people who watch this stuff have been through lots and lots of market cycles, so you have an implicit understanding of where interest rates have been historically. But for younger guys like myself, it's really important and helpful to go back and look at where rates have been over time. And you can see the Fed funds rate. I mean, it's at a historical high relative to the post 2008 period. I think lower rates, and we'll see that in Jackson Hole's speech again. Powell specifically mentions that rates will likely come down, but they won't be at sustained lows like they were during the Great Financial Crisis. So, I mean, this is an interesting chart. Pick your poison. Where's this going? And then should you buy Strife? And the answer is probably yes. What do you think, Soleil? You probably know more about this than me. You've lived a lot more life.
Hey, we don't have to talk about that. Yeah, all the shaded areas on this charts are kind of interesting too, because every time the yield curve gets inverted, we get a shaded area, aka a recession, and it just seems like they have to print their way out of it. But you see that little tiny one at 2020, and so I mean, the only way we get a soft landing is if they lower rates now. And kind of make up for that overcorrection I think that they had when they were pumping rates, and basically screwed over the banks, promising them that rates were going to stay low forever, and then presto changeo, they kind of lied about that one. But and so I need to really learn how to learn how to like understand Fed speak, because they'll say one thing and you kind of have to like read between the lines and figure out what they're really going to do, because they might just play the reverse Uno card on you.
Specifically, completely.
Yeah, so I don't know if that
perspective.
I don't know if that tiny little recession line at 2020, I don't know if they cooked the books to make it look like that was all the recession was, or whether we really had just been in a rolling recession for like 2, 3, 4 years maybe, and you can see that maybe we're recovering from that.
I highlighted a couple points from the Jackson Hole speech, and I'm going to go through them, and you can interpret them as you wish. But I think a few key points kind of start to emerge as you read in detail. The labor market is a case in point. The July employment report released earlier this month showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Slowing in both the supply of and demand for workers, this unusual situation suggests that downside risks to unemployment are rising. This was an allusion to AI, and then downside risks to unemployment are rising. This is the justification for lowering interest rates. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and higher unemployment. This is very explicit, saying they're very concerned about rising unemployment in the face of, not materially higher unemployment yet. A reasonable base case is, Soleil, hop in.
I was going to say with that, I mean, the jobs, I don't know if that's just an excuse to lower rates, but with AI particularly, I mean, I see you put that in the margin. I mean, it's coming for all of our jobs, right? Which is why I think when Tad said that, I think it was when he was his first interview with Tim, he said that if AI is going to do all of our jobs better than us, you might as well just do what you love, because you don't want to do something that you hate and a robot still does it better than you. Like that's not a good look for your future. And I think really that's just a good point to go back to the beginning and realize that we're all Bitcoiners. And what AI is going to do for deflation is going to benefit everyone in the world. It's going to make everything cheaper. But if the fiat system is going to put up a fight, then it has to inflate to counteract that. Otherwise, fiat kind of can't keep up. So it's just a good reminder that Bitcoin is really the only solution and way out, and it's the way that we can capture the actual deflationary pricing basically forever. If you're not into Bitcoin, then you're getting left behind.
And Soleil, that reminds me of this clip I posted the other day on the Peter Diamandis Moonshots podcast. Let's listen to it real quick.
I can't hear.
Oh, you can't hear?
Did you share with audio? You might have to reshare the whole entire screen and check the audio box.
Okay, let's see. Share, window, share a tab instead. Chrome tab, Twitter, share, done. So, like, can you hear this?
Now, because people are
Yep.
asking, are super
It's low.
asking that question, where do I put my money?
I would do a basket of these to get the general trend and get the general transformative trend. And then I would pick certain verticals where AI can make a massive difference and then invest in the companies that enter this.
What's in your bucket?
Hell knows. I'm trying to put everything into Bitcoin, so it's hard to think.
Yeah, you might have to try it again with the volume cranked up.
Okay, that's all. Essentially, they're just saying.
That's the title to go.
And then I would pick.
Yeah.
Okay, just recap it then.
Yeah, what Salim says is, or what Peter's asking. Excuse me, I apologize for that failed transmission. What Peter's asking is, okay, how are you positioning for the riding the AI wave? And he says Salim says I get a basket of different industry disruptors and kind of be diversified because I don't know exactly what the winners are, but I want to ride the trend. And then Peter says, okay, but what exactly are you buying? He says, well, I'm just buying Bitcoin. So like that's kind of watch what they do, not what they say. So I think that's an important part of the whole story. So now let's look at the inflation picture. Obviously, inflation was a little bit higher than expected, and the effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Rates are coming down. Boom, they said it. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertainty and real-time estimates in the natural rate of unemployment. That's kind of protecting themselves. They don't have to prevent. I don't know exactly what that means, actually. I'm going to leave my commentary out on that. We cannot say for certain where rates will settle and over the longer run, but their natural level may now be higher than during the 2010s. They were effectively at zero, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and environment. However, they're kind of, when you're trying to sell a product or something and you put out a price to kind of locate you may say a crazy price to bring people's expectations to that price, and then you negotiate down very subtly, but you've already fixated them on a price that was way above kind of where they initially had thought you'd settle. This that is, in my opinion, they're referencing this kind of this zero interest rate environment, a very low interest rate environment, and then saying, we'll probably settle above that, but it kind of seems like the undertone is we'll settle lower from here, but maybe I'm overthinking it. And just the last couple of quotes. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we return to a framework of flexible inflation targeting and eliminated the makeup strategy. Flexible inflation, this is the thing that's been going on that you've seen on all the Bloomberg terminals with regards to inflation rate not being pinned at 2% and the target inflation not being pinned at 2%, but it being kind of a variable, flexible target, grow your way out. This is all kind of seems to be cut from the same cloth.
Yeah, and just a reminder for everybody that everything that they say is Keynesian bullshit. So they think they can just control the jobs and the inflation and unemployment, and we'll just crank this knob up and crank this knob down. And I mean, they literally only have a few things that they can do. They can adjust the interest rate and they can print. So they're going to screw it up one way or another. Or even if they do it right, what's the guy that always talks about the way that the world works? Anyway, he always calls it like a beautiful deleveraging or some other kind of ridiculous thing. But they have to print. It's just inevitable. They think they think they can do these things, and really they're just kind of handcuffed to their 2 or 3 levers that they can pull.
Exactly. We look at the dollar. I've never been able to trade the dollar with that much accuracy. So I know a lot of people are calling for a breaking down of the dollar to help grow our way out of this. Soleil, any comments on the dollar before I move on?
No, I don't know jack about the dollar.
All right, fuck the dollar. Weekly Bitcoin gold. Yeah, this is a pretty big chart. I think more people are starting to look at this. I feel like 2 months ago, the hot chart was global liquidity overlay with BTC, which is kind of a manufactured chart because you fit the global liquidity to the BTC price and then trying to assume where the Bitcoin price is going. And you can really fit a lot of charts together based on kind of data manipulation. So I don't think that's a be all end all chart. BTC gold, we're sitting around the 2021 all time high, 2022. And I mean, I don't think you want to fade this chart. I mean, we could be topping, and it's all, I mean, and gold's been on a tear. So if gold falls, I mean, we could see this expand while we chop steadily higher.
Wait, which one is Bitcoin in the numerator or gold? Is this
BTC
gold
divided by gold? So this is Bitcoin
Really?
priced
Okay.
in gold. Yeah.
Yeah, I mean, it seems like gold has to go to zero eventually, but I don't know. Maybe a bunch of countries decide to peg to gold again to try to save themselves.
Yes, I think it's a both and. I think Bitcoin and gold, but you'd want to see the point. Bitcoin will continue to outpace gold over a long period of time. And if you look at the BTC gold power law, we're still sitting along the floor. So I think gold is being treated. I mean, we've seen all the central banks trying to buy up gold. So I think
Wait, so there's
yeah, go ahead.
there's a gold power law too, so no dollars.
Yeah, you can price because it's essentially just a different unit of account, right?
Interesting.
You can price BTC USD, and we're sitting right along the trend there. So you can have we have an expected 40% annual CAGR now, decreasing to 30% over the next 5 years. But pricing gold, we're sitting right along the floor, the very bottom of that arc. But I don't think gold recently has been. Like, you could argue that gold represents stable prices, but it seems like gold is still being speculated on. So I don't think gold is necessarily hasn't been increasing at the inflation rate over the past year, is the point I'm trying to make.
Yeah. The most annoying commercials that I have to listen to on my favorite like libertarian podcasts is like monetary metals. I'm like, come on, guys, buy freaking Bitcoin.
But it's good, right? Like this will trend up and to the right. And so a lot of people are worried about topping. A lot of people worry about cycles. As long as we're sitting here, I'm super comfortable. I'm very, very comfortable sitting at an all-time high price in gold, right?
Mm-hmm.
Especially if gold remains strong moving forward. I think the outlook continues to look positive. Maybe we don't get a blow off. Maybe we get a grind higher, especially with the interest rate environment we just talked about. They're going to be cutting for the next year. Like, think about what happened in 2020. Interest rates were taken to zero, risk assets mooned, and then they did the fastest rate hike cycle in the last 2 decades.
Mm-hmm.
And so obviously BTC slammed down. There was a shit ton of leverage in the system, and things melted down. It was brutal. The macro, I think people want to just look at 4-year cycles and be like, oh, this is going to happen, this is going to happen, or look at the price or whatever. Like, I think you have to look at the macro outlook, and then you kind of work your way back to the cycles. It's like, okay, well, you know, we're a year post halving, we're over a year, however many days we are post halving, and the macro outlook, things are getting frothy. Global liquidity is looking to peak over the next 6 months. Interest rates are still very high. We've grinded higher. We're still sitting at a peak in BTC gold. Like, there's a lot of comfort signals. MNAVs have collapsed across the Bitcoin treasury landscape. So that bubble has deflated. Credit spreads are incredibly high in Bitcoin-backed credit. It's difficult for new companies to get funding for a Bitcoin treasury strategy, even though some people have been able to. I just think the top signals aren't there in the Bitcoin market in the same way they are for the equities market right now. But we'll see.
Yeah, and there's always everybody's got their little theory, but if you're political at all and you believe that President Trump thinks highly of himself, he might want the stock market to like completely just blow the roof off throughout his presidency so he can cement his legacy. So don't be short the egos of people that want to put themselves in the history books.
Exactly. And I think, yeah. So Bitcoin Gold, I think one of the most meaningful charts out there. CMC Fear Greed, CoinMarketCap. This is a couple days old. We're now like sitting at 40. And this uses options data across different exchanges and some other inputs. I forget exactly what all the inputs are, but this is a great chart to look at. I mean, you can't trade it. You can't directly trade it, but it gives you a sense if you're overheated. I think extreme greed is a place you really want to avoid, taking leverage out. But as long as you're neutral, like as long as you're kind of in that neutral zone, even in the lower greed zone, really anything could happen. It's anyone's game. The market's not pushing you in one direction necessarily. So, that's a good one. Strife Strike, both taking a beating. That's a bummer. I mean, I think a lot of people made nice exits, hopefully, around these higher prices as they started to see this kind of turnaround and the ATM start to be put online on those two securities. So I hope everyone made a lot of money there. And I think we're going to get to run this back here. I'm about to lever up pretty big for the STRF dividend coming up, like big, just to collect the dividend. And then if, let's say, people sell right after the ex-dividend date, I don't mind holding those securities on margin. I think by those securities, I mean specifically Strife. You could do this with Stride. Problem is, I don't want to hold Stride for a long period of time if I have to. Strife, Strife is the only one I will because of the different covenants in the prospectus. Strike ATM. So I did a little chart here showing the weekly ATM issuance on STRK. They're marked by these dotted lines. Those correspond. There's little numbers there. You can't see them with the actual issuance here of STRK weekly issuance. So it's been pretty consistent. There have been periods of time during which it hasn't been issued. I'm missing kind of the most recent one as well, but pretty consistent, ramping up. It's a high percentage of volume. If you look on a weekly basis, it's anywhere between 15 and 30% of the weekly traded volume is issued via ATM. So these are resilient securities. And once the volume continues, if the volume continues to build, which we've seen, and the volume's not bad here, the volume is still higher than it was in the winter months. I think these are going to be, pretty popular securities, and they continue to be.
Yeah, and if we do get the rate cuts, it'll be bullish for these preferreds, which should be bullish for the ATMs.
Completely. Yeah, I mean, can you imagine we get a 50 basis point rate cut? Well, I mean, these are professional securities. I mean, I know Luke Roman's got a lot going on. He's like, and Visser's talking about this as well. It's like, what if we see, a Fed funds rate cut, but then the long end of the curve goes up, right? With like anticipatory inflation expectations. Like, what if the 10-year doesn't come down or the 20-year doesn't come down? I mean, that's a real possibility. This is extremely bullish for stretch, which is the short duration. So that's a crazy scenario, Soleil, and we should talk about that right now. And I'll put the stretch price up just so we can ponder on it. 50 basis point rate cut in September. August 31st, the dividends increased by 25 basis points on stretch because they're trying to push it up to par as quick as possible. So, I mean, your short term, you're probably like so you're at close to a 4%. Month T-bill rate, and stretch is paying 10%, right? 600 basis point credit spread. I mean, come on. And it's trading up and it's at par. If those two, that could be the perfect storm for stretch. Now I'm thinking about it. I think we got to lever up. So
yeah, and I was talking on my stream that I was excited for the next pref to come out, and somebody had to check me in the comments. They're like, "Can we get STRC up to par first before we release another preferred?" And I was like, "Okay, yeah, you got a point there." And maybe that's what they're doing. Like maybe they're just ready to release it, and as soon as they get it to 100, maybe that's the starter's pistol for the next preferred.
Yeah, I think stretch is their winning horse here. So, and they gotta get that thing up to par because people don't want to fuck around with it below par right now because they know it's going to be difficult for them to stabilize it. It needs to get to par. The liquidity needs to build, and we need to see how they respond to the current pricing via a change in coupon rate. When the coupon rate is announced, it must be the business day closest to the end of the month. But the change in the next month's coupon interest rate will be announced at the end of this month for the next month. And the ex-dividend rate, the date at which you have to be holding the security, is recorded on the 15th of each month. Those are very important. So, for example, if the dividend rate is increased by 25 basis points for next month, September, and you're holding it by September 15th, you get that dividend payment even if you sell it after that point in time. Strife ATM, more and much less aggressive than strike. That will be a continued theme. We can talk about Bitcoin ratings later. Stretch price, very limited amount of trading days. Lots of green recently, which is very cool. You can see volume is much higher than the other prefs. I think volume will continue to be very high. Stretch mechanism. So I got this wrong. There's an optional redemption. So strategy is able to redeem the stretch token at 101 per share, which should put kind of a gravitational force around that price, able to stabilize it up around 100. And bonds a lot different than kind of ATM mechanisms. So like that redemption tends to put a ceiling on the price of the bond. So 101 kind of, this is the targeted ceiling, and that's upon the what do you call it? The decision of strategy. Strategy is able to redeem at 101 STRC whenever they deem it fit. Now, you can also look at the ATM issuance. There's no regulated price at which they can ATM. They can ATM at any price. They don't have a hard floor, but they're able to, they're able to issue ATM above the 100 floor. And I forget exactly the specs here. So there's no hard floor, but they have a mandate to keep it between the 99 and 101. And so, ATM likely won't occur below 99 because optically it would be terrible.
Yeah, it makes sense.
But, we can expect ATM to happen between 99 and 101, and we'll be tracking that on a weekly basis. But there's no hard kind of cap on the ATM price at which they can sell. This allows them to algorithmically manipulate the price on an interweek basis. Right now, there's two levers at which they can pull, right? They can pull the monthly dividend rate change. That's how they can manipulate the price of the security. They can also redeem at 101, and they can issue ATM at any price. But, they're going to use that to their best ability. Strike redemption. There's also redemption clauses if, the number of outstanding strike falls below 25% of the initial issuance, but that's all like classic pref stuff. Anything there? Soleil? I rambled through that, but
No. Keep going.
all right on. S&P inclusion dates. This is important. So the committee decision will be announced on Friday, September 5th, 2025, and the actual inclusion will be effective September 22nd. So that's the third Friday. So what is that? The first Friday in September is the announcement, and the third Friday is the change become effective. The open on Monday after the third Friday of September. If anyone's curious, if anyone's looking to gamble, I don't think that's going to happen. I think that info gets leaked, and the market doesn't seem to be front running it. So I'm not betting. I'm a betting man, and I'm not betting on that.
Yeah, is there a that betting website? Is it actually on there? I wonder if anybody's.
I think it's on there. Yeah,
is it really?
Or something? I haven't looked. That'd be actually an interesting data point. We should look that up.
Yeah, don't they always? Aren't they pretty reliable? Like, didn't they predict the election results and all that good stuff? Like, it was actually more accurate than the polls.
Yeah, leading into it. But I bet you feel the same way about the polls I do. But I mean, they're also saying 62% chance Bitcoin goes below 100 between now and the end of the year, which I mean, I guess that's probably the right percentage. I mean, I would put it at a coin flip. So yeah, I guess that's fine. And also, I think people forget, like, when it comes to financial securities prices, there's all kinds of hedging that goes on. Like, there may be an arbitrage between taking that bet, going long that bet, or going short that bet in some options position over the next 6 months. So I really don't think those are as reliable as people would like them to be. Like, if the options market has a different probability, then theoretically you could close the spread between those two kind of different wagers, and there'll be the kind of mispricings. But maybe those get arbed out, and it is accurate probability representation. I don't know.
Yeah, and I guess we still got some Bitcoin whales that are big enough to, a weekend or two ago, that somebody sold a bunch and crashed the price. So I guess there can be some shenanigans going on.
Yeah, I'd probably be if we go down to 90, I mean, I'd be buying 2-year out calls. I would totally change the strategy. Yeah, I would be buying like really, really long dated stuff, because then we could see like 6 months of like I mean, right now we can see 6 months of brutal disaster, but if something goes like anything below 100, I mean, you just want to be levered long over a really long period of time. But if you're like at 130, 140, 150, 160, 170, you got to be kind of more Nash equilibrium. Like this thing could blow off, but like I don't want to be sitting in 2-year calls at 180 Bitcoin. Like that's just not smart, you know?
Yeah, I got excited for Power Law when I first saw it, and then I kind of had a little bit of second thoughts about it. But one of the more interesting ones that I heard recently, it was like, I can't remember if it was exactly called like fair value or something, and it was based on the price that Bitcoin should be at for miners to actually make a profit, since they're the ones that should be setting the market. Like they can't operate if they're not at a profit. And this guy was saying, Bitcoin should be at 320 right now.
Oh, wow.
So that's bullish. But, who knows? Like all the models are, how does it go? All your models are
destroyed.
Not exactly, well, not destroyed, but I mean, I say that too, but it's like they're useful, but they're not all 100% accurate.
Completely. Yeah. No, this is a human phenomenon at the end of the day. Pricing a security or pricing a commodity is based on the market participants. So, and they're unpredictable.
Yeah. And the markets are rational as fuck. So
exactly.
That's not going to change anytime soon.
Looking at dividend liabilities here. Right now, this is a bit off, but there's just over 600 million annually in preferred equity dividend liabilities. I did a little rough math. If you were to clear out all the converts and issue the same blended percentages of each of the common to replace the converts and get you back up to that about 20% leverage ratio, you'd be looking at about 1.4 billion of annual dividend liabilities. Kind of seemed like a lot to me. But I get that that's, a small percentage of the daily or weekly traded volume. But I was like, the market's not going to like that one. 1.4 billion in annual dividend liabilities covered by the common ATM. So we'll have to get some good messaging going out there. But I mean, that's why I do love the idea. It's like, what if you just raised common, you just slam the common ATM 1 week or 2 weeks, you get that 1.4 billion and be like, yeah, we have our dividend and cash reserve for the next year. Like, please don't bother me.
When we weren't having an episode tonight, I was actually going to share the Preston Pish interview that he did most recently. It just came out today, I think.
Oh, cool.
And he was saying, one of the things that you have to remember is that unlike the convertible bonds, these preferreds they don't have to pay the principal back, right? So the $1 or $2 billion worth of Bitcoin that they bought at the initial offering, it's just on the balance sheet forever, and they don't ever have to just, they have to pay the dividend, but they don't have to pay the principal back.
Yeah, exactly. It's perpetual short USD long BTC position. Pretty incredible. If you're a real Bitcoin believer, then I mean, it's an infinite duration bond, which they're able to meet with kind of just the volume and the common. It's pretty crazy when you think about it. They're going to be a massive company. And then, let me stop sharing and open up my last. I wanted to give people a sense of where kind of an overall pref market cap could be, because it's hard to quantify. Like we're talking like, prefs could be successful. And people are like, okay, cool. Like, what does that even mean? But you got to put it in numbers, I think, and look out far. So I've got a, 40% decreasing to a 30% CAGR in BTC assumption and an assumed constant MNAV of 1.6. So these are just assumptions. Like don't nail me to a cross because I said 1.6 MNAV or whatever. Assumed Bitcoin prices. I have like a little bear market scenario I just did for myself in here. But I say, okay, so based on your assumption of mNAV and Bitcoin price, and you have this consistent running 300 million scaling up to, 6 billion monthly ATM usage, which isn't totally fine, but it's just it's a monthly ATM percent of the market cap. I use conservative numbers historically, and that's how I set the common ATM usage. So common ATM is consistent throughout here. You've got, Bitcoin price, Bitcoin amount of Bitcoins. And then you have the real thing is the target debt ratio. So right now, the target debt ratio is give or take at a 30% debt to equity ratio around 17 billion. Right now, these are all old numbers. We're sitting, 14 billion roughly. We're sitting in low teens of actual debt. That's both converts and prefs. But if you run this scenario out, you just keep the MNAV constant, you keep the ATM running, and you keep the Bitcoin price increasing, and you try to meet this 30% debt threshold, how big does the preferred market cap get? That's the real question. How many of these preferreds are out there if they can just continuously meet this 30% debt leverage ratio? And if you get out to 2031 and the price of Bitcoin is 500,000, 600,000, call it, let's just use here 500,000 at the end of 2030. And that 30% leverage ratio is about 200, I think that's million. So you're looking at a potential market cap of all the outstanding prefs if they maintain this leverage ratio of 175. That's billion. So 175 billion, right? Like that's nuts. If the preferred market cap is 180 billion in 2030, these things were a smashing success. So it's just a matter of how quickly that liquidity develops across those products. But I mean, I don't think there's a reason why this couldn't happen. And this would drastically change the landscape for Bitcoin, for bonds, for US denominated, for government issued securities across the board. Like this is really a pretty crazy thought experiment, but also a reality.
Yeah, and that's another thing that Pish mentioned was this market is it 100 trillion, 300 trillion? It's a bunch of trillions, and it's usually, what is it going to be, like winner take most? And there's going to be a bunch of people that follow strategy into this market, but strategy is the first mover, and they're going to have the highest percentage of whatever those, however many trillions that is. And by 2030, however many hundreds of trillions of dollars it is, that'll probably double by then. So it'll just be the dominant slice of an even bigger pie. You're muted.
Yeah, completely. I totally agree. Totally agree. So
yeah, I think
in my head, it's Strife. It was in our thumbnail. I want to let everyone know.
Yeah, I've got a bunch of chips on the table, hoping for one more pump. So, if it doesn't happen, it'll be kind of brutal for my portfolio. But I have at least I can console myself that all of the longs, all of the leverage that I purchased was funded by the short calls that I sold in the first place. So even if those all expire worthless, it was basically just all the money that I made for myself on the covered calls to begin with. So it'll just be a break-even moment for me.
Completely, yeah. No, I mean it's really hard to know right now. It's not 2022, 2023, 2024 anymore. It's the end of 2025.
Yeah, and Bitcoin loves to like okie doke you. Like as soon as you think you see a pattern, and it's like, oh yeah, I see the code in the matrix. It's like, okay, 4-year cycles, and then everybody thinks they're real. You could say that it's a self-fulfilling prophecy, but then maybe everybody gets surprised, and maybe we get the super cycle that everybody wants, or maybe we get an early bear market, and who knows, maybe the Fed screws up the whole situation. But I don't see that happening. It seems like rates got to come down, and that's just bullish.
Yeah, I agree. But who knows? Could be priced in here. So I think you got to tread lightly, but carry a big stick.
Yeah, we covered everything on your agenda. Anything else you want to get off your chest that you just couldn't wait 3 more weeks for?
No, I'm glad we did that. There's important stuff going on. I know it's end of August, but it's important to keep momentum through the fall, whatever happens.
Oh yeah, and I mentioned that the whole point of this is to try to get some signal for investors, because Jeff saw what happened with the GameStop trade and how much just bad information was out there. And so there's that. But then I think we're also kind of like a little bit of a litmus test for Bitcoin treasury companies themselves, and we're going to be highlighting things that we think are good, and things that we think are maybe Bitcoin treasury companies shouldn't be doing. So hopefully will be informative for the BTC TCs themselves. You got any final thoughts, or should we wrap it up?
I mean, let's wrap it up.
Hell yeah. Thanks everybody for jumping in on our impromptu session, and thanks to Dan for just being in the lab and pumping out a bunch of research for us and making us not wait another 3 weeks.
Thanks for listening, guys. It was good.
Thanks.
Talk soon.
Be good, y'all.